This is Optimal Finance Daily, episode 2020. Why is it so hard to retire? By Odegard of theprolificinvestor.net. And I'm your host and personal finance enthusiast, Diana Merriam. Let's jump right into today's post to start the week as we optimize your life. Why is it so hard to retire? By Odegard of theprolificinvestor.net. If you've read any of my writings, you know I come down hard on conventional investing wisdom as inferior at best and a downright failure for most people at worst. But before I continue my rant on this flawed philosophy, I need to discuss two of its popular principles. Number one, building a balanced portfolio of stocks, bonds, and mutual funds through 401ks and IRAs. And number two, the 4% rule. The first principle is to contribute the maximum amount to your employer's 401k and invest it in a diversified portfolio of stocks, bonds, and mutual funds. Then, when you decide to stop working, you regularly sell off your portfolio shares to produce the cash flow to pay your bills. This is where the second principle comes in. The second principle is the 4% rule. The 4% rule was developed in 1994 to provide an easy way for retirees to determine how much they should withdraw annually from their portfolios. Regardless of how you feel about conventional investing wisdom, let's apply the 4% rule and see what it tells us. Firstly, what annual income would you like in retirement? Let's say your number is $100,000 per year. Then, using the 4% rule, how big would your portfolio have to be to achieve this income? $100,000 divided by 4% is $2.5 million. In other words, to have a retirement income of $100,000 per year, you need a portfolio of $2.5 million. If you have this size of a portfolio, there's a name for you: multimillionaire. Since the 4% rule is for everyone, it might be interesting to know how many Americans are millionaires. According to a CNBC article, approximately 8% of Americans have a net worth of $1 million or more. So that means that even fewer are multimillionaires. How close is your portfolio to 2.5 million? Not that close? Perhaps we set our sights too high. According to Wikipedia, the median U.S. household income was approximately $63,000 in 2018. So let's rerun the 4% rule with the median U.S. income. $63,000 divided by 4% is $1.575 million. For 8% of you, congratulations! You're part of the minority of Americans for whom conventional wisdom works. So why doesn't the conventional path work for 92% of the population? I believe there are two main reasons. Stock market returns are too low and too volatile, and people don't invest enough. Stock market returns are too low and too volatile. Conventional wisdom says to make riskier investments and have your portfolio balanced more heavily towards stocks and away from bonds to get higher returns in the stock market. The problem with this is that you might make more money if you make riskier investments, but you also might lose money. So that's not a good solution. As far as shifting your portfolio more towards stocks, since bond yields are so low today, I think most investors are already skewed towards stocks because it's the only place to get any significant positive returns. To have a less volatile portfolio, you typically allocate more of your portfolio towards bonds. But unfortunately, while that might work, as we just learned, it also drags down your returns. Ergo, this whole conventional wisdom thing seems to be breaking down. It's a no-win situation. People don't invest enough. People don't invest enough either because they're just super spenders or they don't make enough money. There are two lifestyle solutions to these problems. If you're a super spender, that's a more straightforward fix. Spend less and invest more. On the other hand, suppose you simply don't make enough money. After you pay all your bills, there isn't that much left over to invest. In that case, you must continually improve yourself and become the best at whatever you do for a living, so you get the highest possible salary and regular promotions and pay increases. provided you don't spend the extra money. Now you can invest more for your future. Conventional financial planners have a fix-all solution for those who don't invest enough money. Work longer and spend less in retirement. That's it. Sounds awesome. Work until you're old and decrepit and then live like a pauper. This doesn't sound like the American dream to me. To facilitate spending less in retirement, the conventional financial planning industry is starting to recommend a 3% withdrawal rate, not 4%. Let's apply the now 3% rule to the median income and see what it tells us. $63,000 divided by 3% is $2.1 million. So we're right back where we started. You need to be a multimillionaire just to have the median income in retirement. Thankfully, there is an answer, and it involves leaving the stock market or conventional investments and moving to alternative investments. Alternative investments include real estate, precious metals, notes, business equipment, private lending, private shares of small businesses, cash value life insurance, and many others that are not publicly traded. The benefits of alternatives over conventional investments are numerous. Alternative investments provide annual returns of 15 to 30%, are less volatile than conventional investments, provide cash flow, allow you to pay little to no income taxes on their returns, are stable enough that banks will loan you money to buy them, and provide real diversification. Let's explore how alternatives can help by looking at 3 factors that affect your ability to accumulate money for retirement or financial freedom: the amount of money you invest, the return you earn on that money, and the length of time your money is invested. The amount of money you invest. The amount of money you invest doesn't have to be your money. It can be other people's money. Banks will loan you money to buy alternative investments, like a piece of real estate, so you don't have to rely on your cash alone. Banks will not loan you money to buy conventional investments. The return you earn on that money. According to Investopedia, the S&P 500 index's average annual return since its inception in 1926 has been 9.8%. But according to The Balance, the average equity fund investor only earned 5.19% annually. Think about that, a measly 5.19%, and that's before inflation and taxes. With alternative investments, it's commonplace to get annual returns in the 15 to 30% range, and sometimes that's before the built-in tax advantages that some alternatives provide. The length of time your money is invested. With alternative investments, you can invest more money using other people's money and get higher returns without additional risk because of the nature of alternatives. All this allows you to accumulate more money in a shorter period of time. Shouldn't that be the goal? Instead of working longer and living like a pauper in retirement, shouldn't the goal be to work less and live like a king? Remember, when you make better financial decisions, someday you can make work a choice instead of a necessity. You just listened to the post titled, "Why is it so hard to retire?" by Chris Odegard of theprolificinvestor.net. I can appreciate why Chris questions conventional investing philosophies. In many ways, the financial services industry has overcomplicated investing, and many of us feel confused at the conflicting information that's presented to us. It's clear from this article that Chris has found an alternative way to invest that works for him. But I would just caution listeners to consider that the methods described here are not risk-free, and there is not a reliable way to get rich quick. While only 8% of Americans are millionaires, according to the largest survey of millionaires ever conducted by Ramsey Solutions, 3 out of 4 millionaires said that regular, consistent investing over a long period of time is the key to their financial success. 8 out of 10 millionaires invest in tax-advantaged retirement accounts, and for 95% of them, it took 28 years to reach millionaire status. When you have a long time horizon, it makes it much more likely that you'll become a millionaire even if you don't have a high income. If you invest $500 per month Assuming a 10% average return with market matching index funds over 30 years, you will be a millionaire. Only 31% of millionaires averaged more than $100,000 in salary earnings, and 1/3 didn't make six figures in any working year at all. The caveat here is time horizon. If you're older and you have a shorter time horizon, you will need to invest more. But it's simply not accurate to say that it's unrealistic to become a millionaire through stock market investing. In fact, that's exactly how most millionaires build wealth. According to my friend Frank Vasquez over at Risk Parity Radio, who discusses asset allocation and drawdown strategies on his show, the 4% rule is not used by anyone as a method of withdrawal. It's used to conservatively estimate how much you'll need to retire at a given level of expenses. The 4% rule is simply a guideline. There are many assumptions in this model that don't necessarily match up with your specific situation or the construction of your portfolio. Rather than plan your withdrawals for the rest of your life based on the 4% rule, it makes much more sense to have flexibility and refine your retirement plan annually. And that's a wrap for another Monday show. Have a great rest of your day and start to your week. And I'll be back tomorrow as usual, where your optimal life awaits.